Well, it is said that variety is the spice of life. In the realm of personal finance, too, variety has an important place. Diversification is the term used by financial planners and investment gurus to allude to the variety element in finances, and it is considered one of the building blocks of a successful financial strategy. Diversification ensures that you can sail through periods of volatility while also tapping into opportunities of enhancing your investment returns during different market and macroeconomic scenarios. However, despite financial advisors repeating often that diversification is sacrosanct, drafting an appropriate asset allocation strategy can be tricky. Lack of knowledge about the dynamics of different asset classes and lack of time to develop adequate know how can make it hard for even the most focused investors to adhere to a sound asset allocation strategy. Investing in multi asset mutual funds has emerged as a sought after choice for many. As a class of hybrid funds, it allows 10% of the investment portfolio in at least three different asset classes, mainly equity, bonds, and commodities. The underlying principle is that these asset classes respond in different ways to a given macroeconomic situation, and thus the risks are ironed out to a large extent in the long run. Well, investments are well distributed across various asset classes, and the benefits of each of them can be availed simply by investing in one fund. Most importantly, you do not have to spend colossal amounts of time and money in building a tailor made portfolio. Hello, ladies and gentlemen. I'm your host, Gautam Srinivasan, and today we have a special presentation where we will delve into how multi asset mutual funds are the way forward and how their addition to your portfolio can be advantageous. Kaustubh Belapurkar, Director of Fund Research at Morningstar, is joining me in this conversation to provide his insights. Kaustubh, thank you so much. Welcome to the discussion. And of course, thank you for joining us to provide your expertise on the topic. Let's start things off from a broader perspective. Asset allocation, that's believed to be a touchstone for a successful investment journey. So let's know from you, how does asset allocation help in goal fulfillment in different stages of an investor's life cycle?
Uh, Hi, Gautam, and thanks for having me on this discussion, and hello to all the viewers and listeners. So I think it's a very very pertinent discussion that you bring about, Gautam. That asset allocation, and there have been various studies that have been done. While the numbers might vary, I think the underpinning really findings of that is that asset allocation is the primary return driver for any portfolio. That means you have to get the basic ingredients of your asset allocation right for any investor's portfolio to maximize or kind of lower volatility and maximize the returns as a part of your portfolio. Right? I think that's really the golden rule. I mean, if I were to draw a comparison with sport, it's almost like building choosing a playing 11 for your cricket team. I mean, you can't have all batsmen or all bowlers. You need to have batsmen, bowlers, a wicket keeper, an all rounder. Each of them playing different roles. Right? So asset allocation is a very similar sort of structure in that, where there are, and you touched upon some of these asset classes, the popular ones that investors look at, be it equities, fixed income, commodities, especially gold, and there are a couple of others that some of the multi-asset funds can invest into. I think these are very very important to kind of bring it into a structure of a fund and diversify your portfolio. And why is that important? Because every investor comes with a different goal, a different investment time horizon, different risk return parameters, right? So, for instance, there could be investors who are looking at very, very short term investing, maybe a year or a couple of years. There could be investors who have a longer term sort of time horizon, but are probably not as risk loving as some of the others, right? So all of these would have different levels of asset allocation that demands. But the point is that you cannot populate your portfolio with a single asset class and try to, just stay out of the market, right? Because when I think about these various asset classes that we spoke about, we all know that equities is a great long-term, investing asset class. But as we've seen in the recent past, and we've seen, during the March 20 crash, equities comes with a fair amount of volatility. What is volatility? Movements in the price of the index of the stocks of the funds that you own, and it can be quite dramatic, right? I mean, if I just look at the last 10 years, which have been relatively good years for the markets, as a whole, There have been periods, even if you held equities for 3 years, you actually made marginal negative returns, right? And history has taught us that over a 3-year period, you could even make the minimum returns are even as low as -10%. So the range of returns on an asset class like equity can be quite wide, right? And that's where the context of volatility comes in. Then comes in a second asset class, which is much less volatile, something like fixed income. And that why that makes sense to kind of pad that with equity is because while the overall returns may not look as attractive as equity over the long term on a relative context, there's greater predictability to the returns, or the range of returns is much, much more limited on a smaller set, right? So, for instance, typically between +4 to +12%. So, mind you, in most cases, you wouldn't have made a negative return on fixed income side if you were in your safer duration categories, low duration categories. And when obviously yields are going down, you could have made a slightly higher return. But the range for returns is limited, which means the volatility is low. And then you have this interesting asset class, commodities, and especially something like a gold, which obviously Indians love holding. Can be a great hedge as we talk about in times of crisis, right? When there's a macroeconomic crisis, or the world is going through a huge upheaval, be it the global financial crisis, or there's a war-like situation, or the global, obviously the COVID pandemic. We've seen that gold prices have tended to move up and provide a good hedge in markets where maybe equities and bonds are not really doing anything. So the point that I'm making is that each of them have their own unique characteristics, different time holding periods. But when you marry the three of them together, what it can do is you have one class which is more volatile and more aggressive, like equities. Marry that with a fixed income asset class, which can be much more stable in its performance or its return criteria, and then gold, which is more of a hedge against really significant events that can happen as we've seen in the recent past. So I think if you can get a portfolio of these three, and this, mind you, can vary across an investor's risk appetite and investment time horizon, but this can really give you great benefits of staying invested because no one knows when each of these asset classes will perform, right? I mean, I'll give you a classic case of gold. A lot of investors sat out of gold, at least people who are buying physical gold, but not necessarily buying gold ETFs or sovereign gold bonds up to the year 2018 or 19, because it did nothing from 2012 to 18. In fact, it kind of moved downwards, right? But we've seen the kind of appreciation. In fact, gold's been one of the top performing asset classes in the years 18, 19, 20. Again, it's gone bottom of the pile in 21. No one can time this. So you need to be invested in that asset class as a part of your portfolio rather than trying to time entry and exit, because that can work against you both times. So I think that's really the underpinning philosophy, that if you have a certain objective or a goal in mind, you can build an asset allocation through these basic building blocks of the asset classes that we spoke about, and you can build a portfolio that's much more resilient in different market cycles rather than something that's very lumpy at a certain point of time and then comes crashing down at a certain point of time. So I think that's really the underpinnings of a good asset allocation when you think about it.
All right, we'll expand on that. And it's all about the balance. Interesting, you gave the cricketing analogy, considering, balanced teams who are given an outside chance are topping the chart. So it's always about making sure that you have all the elements in play. And we're seeing more and more investors, they're warming up to the idea of investing in multi asset mutual funds, what with their investment being more secure, owing to the diversification factor that you spoke about, Kaustubh. And the multi asset route is also a judicious choice, I guess, if your risk appetite is low or you are still testing the waters. So, basis that, could you elaborate on the strategies, Kaustubh, used in multi-asset fund management? How is the asset allocation formula decided, and what's the criteria for allocation in multi-asset funds?
Sure. So let me just first lay out, and you did allude to that at the start of your discussion in terms of really what are multi-asset funds, right? So, what SEBI has, the regulators come out with the definition of what a multi-asset fund should do is basically own at least three asset classes and a minimum of 10% and in each of these asset classes, right? And when you look at the multi-asset funds that we have quite a few of these options within the industry. The three primary asset classes, we also spoke about them, are equities, fixed income, and gold, and commodities, and there's a significant flavor towards gold within that, right? So I think these are the three primary asset classes that are owned by the multi-asset funds. Most of the multi-asset funds, and I'll talk about some of the other sort of investing opportunities that funds do pick within this. But most of the multi-asset funds that you would see structured would have a significant allocation towards equities to start with. And I think investors would be best served to look at the underlying mandate of these funds, because it could vary across funds. But I think the broader underpinning strategy is that, look, given that equity is a great long-term asset class, we want to get investors exposed to equities as a significant portion, and also there's a tax angle to it. But typically most of them would tend to own north of 65% in equities. It could be a mix of Indian and foreign equities, but that's typically what a fund would look to own. Beyond that, they will also have bands which they've defined that they would look to own and say fixed income, depending on obviously the way they're viewing either equities being attractive or not attractive. And again, there are fund managers who could take a call depending on their horizon, or they could run valuation models saying that, okay, equities are overvalued, I want to bring down the equity allocation and maybe get into more less volatile asset classes such as fixed income. So typically fixed income would be in a band of 10 to 30% for most of the funds. And then there's commodities. Again, there's an interesting and a different play here. There'll be certain funds that will be probably holding mostly gold, but there are also funds that would probably do some sort of commodity strategies. Could be commodity arbitrage. Basically locking in. I won't get into too many details, but basically looking at sort of almost risk-free commodity arbitrage on various other commodities, or take some marginal unhedged commodity exposure on certain commodities where the fund manager wants to or thinks there's a view that he or she can express, right? Beyond these three, there are also other sort of asset types that fund managers, certain funds do run. For instance, the regulator allows up to 10%, and some of them have taken exposures in what we call real estate investment trusts, or REITs, or in fact infrastructure investment trusts, the InvITs, right? And these again very interesting opportunities for investors. Obviously, if there are opportunities that are available in the market for fund managers to buy, where we've always been great real estate investors, buying properties. Indians love that, right? But if you can get exposure as an investor through a REIT, where you're getting a mix of rental yield plus appreciation in the underlying property, or an infrastructure project, like a highway or toll road, or something like that, are interesting opportunities that don't necessarily exist to every retail investor. They could get exposure through that, through a multi-asset fund as a part of their portfolios. So I think there are different flavors within the multi-asset space, and I would really urge investors to think about what the underlying mandate of each fund is. But these are, I would say, the broad underpinnings. Equity will tend to be a large component, and I would say that is an important component, because that's really going to be, your long-term return driver, along with the diversification through the other asset classes that we just spoke about.
All right, let's also take the conversation in the direction of how this variety of multi-asset funds can help investors withstand volatility, because you look at the markets all around, you see volatility. And in an age where distractions are many and the grind of our day-to-day lives keep people away from actively investing due to the fear of not being able to find the time and bandwidth to monitor investments, I guess multi-asset funds can be that silver lining. Researching and then following a course of action on asset allocations, that can be a daunting task, and relying on experts, I guess, is the way forward, similar to this conversation that we're having and the insights that we are getting from Kaustubh. Now, Kaustubh, you explained how multi-asset funds help investors retain exposure to various asset classes simultaneously, with the advantage of not having to toggle between different assets to maximize returns. So in the context of the volatility that we see right now, and of course over a long journey, how do multi-asset funds help investors withstand these periods of volatility?
Sure. And that's a very, very, very good and pertinent question, Gautam. So a couple of things that happens. One is that it is almost like it's a behavioral hack, if I may call it so, when I think about a multi-asset fund. And this is the experience that we've had dealing with investors, where when you think about, especially newer investors who are coming to the market, who've probably been exposed to equities, or the more volatile asset classes for the first time, when you just purely take an equity fund or an equity exposure, and you see the markets down 20, 30, 40%, as we've seen, and has happened and will happen again in the future, that's part of the market cycle. But sometimes newer investors, or, the less risk averse investors, can get perturbed by this. And when you're invested in a pure asset class fund, for instance, a pure equity fund, that number just looks all that more glaring, right? Uh, but when you do it through multi-asset fund, it's one NAV that you're looking at. It kind of, the behavioral hack that I spoke about, it just soothes the sentiment of the investor. Optically it looks a lot nicer. I could do the same thing by buying a separate equity fund, a separate debt fund, and a separate gold ETF if I want to construct a portfolio. But like I said, for a lot of investors, that one, minus 40% on say an equity fund would really stand out. But if I have a multi-asset fund that buys all of these three, automatically, behaviorally for investors, it becomes a lot more palatable to digest the volatility, because like I said, if equities are moving or are in negative territory, it's possible that we're going through some sort of a crisis. Gold might be moving up. Fixed income is already a pretty steady asset class, so you would be kind of in a more narrower range but a positive range of returns. So that helps investors tide over volatility. The second thing, and more importantly, what it does is a lot of times investors, they're exposed, even if they're buying these asset classes separately. For instance, someone who bought after the crash of March 2020 was probably overexposed to equities, right? They bought in a lot of equities, although their asset allocation suggested maybe you own only 70% in equities. Equities ran up; they were probably owning 95% in equities, and in the recent correction, they've lost a fair bit of that, right? But in a multi-asset fund, automatically you will have some, the manager would take calls like we spoke about. There'll be a rebalance that will happen within the portfolio. They'll buy into opportunities where they think there is greater merit in being invested in, which not necessarily every investor will have the wherewithal to do. So that will help investors again be in the right asset classes. Within obviously the contours, it's not going to be like a multi-asset fund is going to go down to 0% in equities. That's not going to happen. Obviously, like I said, it's important to see where the investment or the band within which it lies. But the fund manager will take that graded call that look, maybe equities are too expensive. I want to bring down allocation. An investor may or may not do that. So I think that helps investors even further in terms of tiding over volatility. And obviously, like I said, the intermingling of these three asset classes, which is really the underpinning of asset allocation, given that they can perform at different points of time. And history has shown us that even if you just look at simple calendar year returns, you can see that it's not equities that rules the roost every year. In fact, I think over the last 10 years, 5 times out of 10, Indian equities were not the best performing asset class. It could have been US equities, could have been bonds, could have been gold. So I think that's really the proof of the pudding, that you have to be invested in all of these asset classes at one time. Don't try to time entry and exits into it. You'll take some tweaks, which the multi-asset fund would do. An investor may or may not going to do that himself or herself, and that's why some of these strategies can be very interesting from an investor's perspective.
Absolutely. That's a very pertinent point. Avoid timing the market, but focus on time spent in the market. We'll take this discussion in that context, because a portfolio that can emerge unscathed from the turbulence caused by volatility is paramount if you're looking at fulfilling your medium and long-term goals. And multi-asset funds can inject that requisite level of diversification in your portfolio that can ensure that the tremors of volatility do not derail investments. So, Kaustubh, what would you recommend to an investor who is, say, unsure about taking the multi-asset mutual fund route? What kind of time frame is suitable for such funds?
Sure. So, firstly, because, like I said, the context that a lot of these funds, and I think majority of them would traditionally have, a significant portion of their portfolios in equities. And now, mind you, some of them might hedge certain portions, but still equity would be the predominant underlying component of that. I would recommend ideally investors should have at least a 5-year investment horizon, which I would think a bare minimum in terms of investing in these funds. The second and the most important thing, in the time horizon, is that these are great tools to do asset allocation. But remember that not every investor's, asset allocation is going to be linked to a multi-asset fund toe to toe, right? So that means that it may be the case that this may not be the only fund in your portfolio. While it's a great tool to do that, because you don't need to buy some of these other asset classes separately, like like gold or even fixed income for that matter. But it's possible that you don't want to necessarily have only one fund or a single multi-asset fund within your portfolio, because that may not be the desired asset allocation that you so demand. So I think investors need to do that little bit of evolved analysis that look, this is a multi-asset fund that's probably closest to where I think my investment horizon, my risk return objectives, my desired asset allocation lies. And if there are elements that you need to maybe think about that, okay, this fund's probably buying 15% or 20% in fixed income. I'm a guy who probably wants a little more liquidity, a little more safety in my returns. I want to go up to 35%. At all points of time. Maybe you want to pad that with certain fixed income funds. So I think that's a little bit of analysis, that investors should do, because, like I said, it's multi-asset fund will follow a certain mandate, but does it meet in its entirety every investor's risk return or asset allocation objectives? No. So it can be a part of the portfolio, but shouldn't be and whole part of the just that fund in the portfolio is. I mean, it could work for certain investors, who really think that this is the way, this is where my asset allocation lies, but it's not necessarily the case for every investor. But yes, can be a very, very good tool for investors to use for doing auto asset allocation, and then kind of fill the gaps for some of the sort of the other asset classes where you think that maybe you need a little more allocation.
Absolutely. It's in the context of that investment need and goals where we need to make that decisions. And of course, we've understood that multi-asset funds can make life easy for investors, with them delivering stable and long-term returns and risk managed through asset diversification. Now, this makes them a convenient avenue for investors to attain their long-term goals. So, according to you, Kaustubh, what is the best way to invest in multi-asset funds? Say someone watching this is bought over the idea that yes, I need to invest. What's the best way for them to invest?
Yeah. So I would say, for every investor, first, it completely starts from the drawing board about, and you spoke about goals at the start of the conversation, that every investor needs to, think about what are your goals, what are you looking to achieve through this portfolio, and basis that, and also think about, if you have an X goal, and what's the investment time horizon that you're investing this money for instance, what is the limits of risk that you can take within the portfolio, and it's kind of that this is the level of risk that you're agreeable to take. This will kind of derive your asset allocation, what you can do. So, for instance, like I was giving an example of, if you're only an investor who probably has just a 3-year investment horizon, you would obviously look to allocate a large part of that money into fixed income, because we spoke about equities can be reasonably volatile or deliver flat to negative returns over a 3-year time horizon. It's happened. It can happen again in the future, right? So I think that's the important thing. What's your investment time horizon? What's your risk taking appetite? And then accordingly decide an asset allocation. If you can't do it, do reach out to a financial advisor who will help you decode that, and then put in the building blocks of a portfolio. So for instance, say if you're a 70-30, 70 equity, 30 fixed income portfolio, and this is purely just for illustration's sake, you can look to buy a multi-asset fund, which would largely be, say, operating in that 65 to 80% net equity band, and a little bit of gold exposure, obviously, as a part of that portfolio. You could look to do that. But if, say, you're a more balanced 50-50 portfolio, you can buy a single multi-asset fund and then also buy some additional fixed income funds that would bring out your overall construct to a 50-50. Because the other thing that multi-asset funds, I think, beautifully do is the taxation of them, is beneficial, because most of them would own about 65% long equities, which then gets you a beneficial taxation versus non-equity funds. So I think that's the other
Mm.
bit of interesting arbitrage, so to speak, that comes in when you think about
Let's expand on that. Could you throw some light on the tax implications of multi-asset mutual funds, Kaustubh?
Yeah, yeah. So the way, essentially, when you think about taxation for funds, uh, you know any fund that owns 65% into long equities gets classified as an equity fund. Now, mind you, when I say long equities, funds can also be hedging a part of the exposure, because they think markets are overvalued. But as long as you're long 65%, net could be lower than 65, you will still get taxation as an equity fund. An equity fund, when you see the current tax norms, you're at a short-term capital gains, which is holding period of less than 1 year at 15%, and long-term capital gains at 10%, with the first 1 lakh being tax-free, right? And that's also pegged to a certain period. I think it was January 2019 as the NAV period where you take. So equity taxation is a lot more beneficial than non-equity taxation. Say if you bought a traditional fixed income fund, The same example, if you were a 70-30 investor, you bought 70 in an equity fund and 30 in the fixed income fund. The remaining 30%, if you're in the pure fixed income fund, you would get taxed at a marginal tax rate, whatever your income tax rate is for a holding of less than 3 years, and then you get 20% with an indexation of greater than 3 years. So, by buying this mix through one particular fund, which gets equity taxation, you can actually get that arbitrage of, more beneficial taxation through a multi-asset fund, as opposed to buying them individually. But again, like I said, it doesn't necessarily be a one size fits all. You have to look at what the desire for your asset allocation is through the exercise that I spoke about, and then accordingly decide, what's the permutation and combination that you can potentially populate in your portfolio.
All right, Kaustubh, as we look to wrap up the conversation and also to serve as a bookmark for the key points that we have discussed, what are the things that investors should look at when choosing a multi asset mutual fund? And also, what are the entry and exit obligations in such funds?
Sure. So I think the first thing and most important thing that investor needs to look at is the broad mandate of within which a fund will operate. Because like I said, uh, different funds will come with albeit slightly different mandates within that. So for instance, there will be funds that are buying 65 to 80% in equities, but certain of them are probably buying a little bit in international equities. There will be different bands into which certain funds will be buying gold or fixed income and some of these other instruments that I spoke about. So the first thing you want to check is what's the broader investment mandate of the multi-asset fund. Obviously, you would want to see historically how it's being kind of managed, the kind of returns it's delivered on a long-term rolling basis, which will give you comfort. But and there, mind you, there are some great managers and some great funds out there with really good track records in history, and you can really look to do that analysis that funds that have consistently kind of delivered over longer periods of time, especially your own investment horizon. Right? So I think that's the primary analysis that I would look to do, and obviously marry that with an investor's asset allocation. When you spoke about the entry exit so a lot of these funds, do have, obviously there are no entry loads that exist for funds, but there are exit loads with a lot of these funds, and typically, I think for most of them, it's about 1% for a year, and I think that's par for the course, anyways, because that's really to dissuade investors to get out in less than a year. And like I said, ideally you should be there for at least 5 years. But yeah, there's an exit load if you do redeem for whatever reason. For most funds, less than a year, you would probably get charged about 1% of your portfolio value.
All right, that's everything that you need to know about multi asset mutual funds. On that note, it's time to conclude our session on that topic of securing your portfolio with multi asset mutual funds. I would like to thank Kaustubh for joining us and sharing his thoughts, insights, and advice. And of course, thank you to our viewers for tuning in. Till next time, this is Gautam Srinivasan signing off. Have a great day.
Thank you.
Thank you.